Good morning, everybody. I think you've just been listening to me typing. I just realised that I didn't have the sound muted. There we go, never mind. We've got a busy meeting, a busy presentation this morning because I've got some news, Richard's got some news, and McHattie's going to be looking at what happened over the course of February. And then I'll be talking to the manager of GCP Infrastructure. So, 1 second. Sorry. Mute myself on the other thing. Without further ado, let's get going. So news-wise, for me, a bit more about Saba, and then something on Vietnam Enterprise, and then I'm going to hand over to Richard. Saba first. Obviously, we've had the first 7 requisitions. All of them failed quite spectacularly. Then they did 4 more, and then they've been busily withdrawing these. So on the 3rd of March, we had the news that they had withdrawn their requisition for CQS Natural Resources. And that just lets the board get on with the review that it was already doing. And it just reinforces Saba's tendency to time waste, really. And not just time waste, there's quite a lot of money goes into trying to fight off one of these attacks, and advisors and everything else. It is all quite expensive. And huge waste of time, given that as we say, the board was already doing this. They are going to announce the result of their review in April. What I really hope is that they don't throw in the towel, because firstly, I do think there is demand for what it's doing. I think the management team is quite well liked and respected. It doesn't make any sense whatsoever to open-end this kind of strategy, because it's got a lot of kind of small cap and liquid stuff in it. And also because when you have a situation right now when commodities are out of favour because people are saying, China's stopped investing, there's no more infrastructure investment, blah, blah, blah. These things are all depressed, and cashing out now at the bottom of the cycle doesn't make any sense. This is now when the trust should be able to gear up and buy companies really cheaply, so that when the cycle does turn, it would make a really lot of money, as it has done in the past. Now, apart from the ones that we knew about because they'd publicly attacked them, Saba put up stakes in a large number of other trusts as well. And one of those was Montanaro UK Smaller. It's been doing all the right things, buying back stock very regularly, trying to keep its discount down. But it looks like, well, we almost certainly did buy out Saba on the 4th of March. So it was a big chunky buyback. It probably wasn't only buying their shares back on the day. It's because, as I say, it's been buying back stock very regularly, but it was most of the buyback that it did. I think we reported 7% discount, but when I checked the numbers based on the NAV that was published and everything else, I think it was about 8.5, something like that, which is narrow, but not particularly narrow. And one of the things that people are very sensitive to is the possibility that Saba gets preferential treatment. We really don't want to see that. And so it's very encouraging that Montanaro has been kept on buying stock back at around the same kind of discount level since. And we expect it to carry on doing that. So there is no argument here that it's sort of given it any favours. And you can see on the chart here, so this is a 3-year chart. Saba probably would have been building its position from about the beginning of 24. I mean, it's hard to know with all of these things because they're all done through stock swaps and everything else with Jefferies and Barclays and all these other big banks. And it doesn't necessarily put the shares in its name until quite late on in the process. But I'm not sure, looking at that discount, that it actually made much of a profit on these. One of the things that Montanaro has done, and I think this is quite like this anyway, it's put a new dividend policy in. So it's going to be paying out 6% of its NAV on a breakdown that sort of 1% a quarter, 1.5% a quarter as a dividend. So it's a fairly chunky yield. That may have caused Saba some tax problems because it's more expensive for it and the way that it tax treatment in the States. and that might be right. We decide to sell out, but we just don't know. It's hard to tell with these things. But nevertheless, it's gone, and hopefully it will leave Montanaro UK alone now. And then it's sort of like a sneak attack. Geiger Counter had a continuation vote at its AGM on the 3rd of March. And as usual, there wasn't an enormous number of shares actually voted. So only about 31.6% of the shares were voted at the AGM. Fortunately, it has a lot of loyal institutional type shareholders who like what it's doing. This is the fund that invests in the uranium and nuclear, basically. And they were voting for continuation. And so the continuation vote squeezed through. But I know that looks like a reasonable margin. That is only kind of squeezing through. And had a couple of those institutional investors not turned up, it could have been lost. Or the directors could have been voted off. So we just do need to be really careful on these, that we do keep voting. And I know it's a rigmarole for some people, but especially where Sub's got a stake, and the Herald is the one that springs to mind. Do make sure you do vote your shares, because Herald's got a continuation vote in its AGM, and we don't want to lose by mistake. Vietnam Enterprise, it's had a bit of a wobbly period. I suppose it's linked a bit to what Trump is doing, but not really. Its stock selection just hasn't been quite as good as some of the other ones, and its discount is quite wide. And so it's got a discontinuation vote at its AGM this year, and I'm guessing that they're a bit worried that there might be quite a big vote against that. So what they've put in place this morning is a new conditional performance related tender offer of 100% of the shares. So if it underperforms the benchmark index, there's no kind of hurdle or anything else on top of that. If it just underperforms the index over the next 5 years, so by the 31st March 2030, then this 100% tender offer will be on the table at price close to NAV. And so you'll be able to get out. And then obviously if it shrinks too far, then they'll just have to wind the fund up. So yeah, this is a good move. 5 years is a long time, but actually, as I've said before with these things, they shouldn't happen too often. You need to look at these things over the course of a cycle rather than just like what's going on year by year. You're still with this thing, you still run the risk that you get a period where everybody's panicking in markets and they all want out, and so the whole fund disappears just because everything was looking dark for this place for like 3 months or something. But that is a risk that this is prepared to take. One of the frustrating things about this, though, really is you can see how much worse it's performing than Vietnam Holding, and the same goes for Vietnam Opportunity too. And Vietnam Holding is still the smallest trust. I know it's trading on the tightest discount. I know it's issued a tiny bit of shares recently, but it's a shame that Vietnam Holding can't grow at the expense of these things that are trading it. There's no real mechanism for doing that I can think of, but there we go. That's enough from me. I'm going to hand over to Richard.
M&A conveyor belt this week. It's Warehouse REIT. So this chart will be familiar with most of you, but just the NAV, which is the orange one, just popping up at the end there, just shows where we are in the market now. It seems we've hit the bottom and we're turning the corner. So these private equity bids are coming in now, and you see a little spike there in the share price. And we'll see on the next page why that is. The company had an offer this week, or it announced it this week. The offer was last week. That Blackstone, which is US private equity, and Sixth Street sort of teamed up to bid for the company. The price was 470 million, which is 110.5 pence per share, which the board has rejected. And that was at a big premium to the share price, but also a big discount to their NAV, which, like I said, is sort of turning the corner now. So on the next page, we'll see a bit more of the detail of the bid. So as has been the case with many of the real estate companies that have gone and the bids that have been tabled recently, it's private equity, and this really is a feeding ground for them at the moment. The discounts that are on offer to them, and sort of the frustration with the shareholders, and they think they can get in there and get these companies cheap. And so they took out last year Industrials REIT, and a couple of years ago St Modwin, and they built up this private company that holds warehouses and industrial properties and stuff, which will be interesting in a few years' time to see how they exit that, whether they list that as one big massive industrial REIT again. That'll be interesting. But what they're attracted by is, yeah, like I said, the wide discounts, the frustrated shareholders that may just want to get out. I mean, they're guaranteed profits on these if they're buying discounts to NAV, and they're quality portfolios, and they've got reversion baked within them. So rental growth just through the portfolio alone, not alone added sort of asset management that the management teams are going to bring. And it's the bottom of the market. So that's why they're doing it. It still baffles me why there isn't any sort of read across from this, or there's no real nothing really happens with share prices after these bids, which baffles me. So private equity can see the valuation, but shareholders are not at the moment. So consortium has until the end of the month to make their intentions known, whether they're going to make a firm bid or not. It may be unlikely, because if you read their statement, it said that they believe the bid attributed full value for the company and its future prospects. So that sounds like they're probably not going to come back with a higher bid. And if you read Warehouse REIT's statement, that they said they were in contact with their largest shareholders, Investec, with 15%, who seemingly were siding with the board in rejecting that bid. So we'll have to wait and see what happens with that one. Maybe someone else will come in with a bid, but we shall see. And then a couple of interesting moves, firstly from Supermarket Income REIT earlier this week, and then today Urban Logistics REIT made a similar announcement as well. So they're proposing to internalise their management structure. So in Supermarkets Income REIT's case, so they're going to buy out the supermarkets team at Atrato, which is the investment manager, for just under 20 million, which seems quite princely to me. But they reckon they're going to save 4 million a year on costs by bringing it inside, which will obviously enhance their earnings and potentially see dividend growth going forward. But they're also going to transfer their listing from a close-ended investment fund to just a normal equity shares category. And they say that will reduce their administrative burden and potentially attract a wider range of investors. So within this proposal, the current principals that lead this, Ben Green, who's led it from day one, and Steve Wins are the same, they're going to remain at Atrato, and the internalised Supermarket Income REIT team will be led by Rob Abraham, who's been at Atrato for a number of years now and has been managing the fund. He's going to stay on, or he's going to be the new chief executive. And then Mike Perkins, who was appointed last year from Urban Logistics, actually, as their finance director, he will become the CFO. And general meeting's been put in for 20th of March, and if passed, that will become effective on the 25th of March. And then with urban logistics, similar, exactly saying they're going to buy out their investment manager, which is Logistics Asset Management, for an initial fee of 6.8 million, which is paid in shares. They reckon that will save them 1.4 million a year, which again will be earnings enhancement and hopefully dividend growth. And they too will transfer the listing from close-ended to normal equity shares. Within their proposals, there is an additional contingent payment on based on their share price performance. In the 3 months leading up to the anniversary of this, the average share price, if it is over 130p, they'll get a 20% or up to 100% of that 5.6 million, depending on where that average price is. So if it's 158p, they'll get 100% of that 5.6 million. If it's 130p, they'll get 20% of that. And then if it's under 130, they'll get nothing. And that's all going to be issued and paid in shares at 114.3p. So it's really good incentive for them to do this. And they've got a 2-year minimum hold period. And it's going to be the same investment team. So Richard Moffat will be chief exec, Jamie Wardgrave will be CFO, and Justin Upton will CIO. They've been there for years and running that, so there's going to be no real change there for them. They've not set a general meeting date yet, but that will come soon, and if passed, they expect this to become effective in the second quarter of this year, which is obviously April to June time. So the reason why they're both doing it, both mentioned administrative burden, both mentioned that they hope it will attract a wider range of investors. And for me, that without saying it, I think what they're talking about is the cost disclosure stuff that's going on, impacting investment trusts and REITs at the same time. Well, externally managed REITs anyway. So it's a double counting of their costs, which makes them look more expensive than the internally managed peers, or even if you were to invest in open-ended property structures. And obviously, if you've got large fees, it excludes some investors from even looking to buy them or even holding their shares at all. So I think that's where it's coming from. Maybe we'll see a few more follow suit if these cost disclosure rules aren't sort of sorted out soon. We'll quickly go on the next slide. Just want to sort of talk about I mean, you could question with all these cost saving stuff, or what is the point in external management? But there are a lot of benefits to it. So economies of scale for one. So the management teams don't just manage this; they manage many other funds, maybe some open-ended, some maybe other listed funds as well. So you get economies of scale from that. You get you benefit from a broader team of skills and wider experience. So just a couple of weeks ago, I was on the show talking about Tritax Big Box and the data center portfolio they're purchasing. That was all sort of from the investment manager and their capabilities and their skill sets, and been lining this up and working with data center industry and power companies for years and stuff, and set up the JV. So they're benefiting from that externally managed structure. And also from a governance point of view, boards can oversee the performance, incentivize the management team, and set poor performing managers. So there are benefits to the external managed REIT regime. It's just the cost disclosure thing and a few other things that are sort of getting in the way that are perhaps behind some of these moves. And we'll see if any more follow suit.
Great. I'll now talk about what's been happening in the investment company sector over the last month. And actually, that was really interesting, Richard. Slightly worrying trend, isn't it, that companies are leaving the sector because clearly the investment company sector is not generating sufficient demand for them for whatever reason. And in a different sector, we saw Taylor Maritime Investments leaving, didn't we, as well? So yeah, we'll have to see how that plays out. But anyway, for what is left, it was a reasonable month, actually, February. The investment trust index that I tracked was fairly flat over the calendar month of February, although it has dropped off over the last week or so. And there were actually some decent rises. And you can see on the list here quite a number of double-digit rises over the month. And I always look for themes, and sometimes there are no themes and there's special situations. But rather peculiarly, I think this month there are very definite themes for both the risers and the fallers. So I've picked them out here in some different colors. We can see, first of all, in the blue, the two takeover approaches. Warehouse REIT, which Richard just spoke about, and also BBGI Global Infrastructure, which I think is a done deal, that one. So some quite good uplifts from those two. In the red as well, we have the three Chinese country specialists, which all rose quite nicely over the month, actually. And I think a lot of that was down to the DeepSeek AI news, which feels as though it's been around for a while, but actually it was the beginning of February. And I think that challenged the existing narrative about US technology being utterly dominant. And I think actually this reminded us that there's some very good technology coming out of China as well, and that is competitive. So I think it refocused investors' minds on the potential benefits of investing in China. And then the majority here in green was a bounce in the very depressed renewable energy sector. And it's that which I'll really go on to talk about, because I think that was the main feature here among the risers over the month. You can see lots of good double-digit gains there. So I'll move now on to the fallers. Actually, a fairly similar quantum here. So just the one Geiger counter there, which James has spoken about, down 23% over the month. And a number of fallers. Again, actually some very obvious themes coming out of this. And in red here, we have those really that are largely American. So we have the JP Morgan trusts here, which are very specifically American, and the tech trusts as well. They had some quite nasty falls, actually. And I think that was echoed as well by the healthcare trusts here in dark red, which are also largely US based. That's just the nature of that industry, that it's largely based in the US. So effectively, a big US sell-off here. And I think as well, the three Indian trusts mark something of that same trend. There's a bit of concern about highly rated markets. So I will come on to talk about the US as well. But we'll start with the good news on renewable energy. And I did talk about this sector last month, actually, saying how depressed it was and how cheap it's looked. But I could have said the same thing over many months, actually, and actually I have. So it's been quite difficult to time this one. But I do feel now that we're seeing some very specific positive action and news in the sector, which could herald a better period ahead. So I've isolated three types of things that I've noticed have been happening in the sector over this last month. Number one is asset sales, which has been an ongoing theme as trusts try to reduce their debt. And obviously some trusts as well are winding up. And that's really what the news was here. Secondly, a promise of more strategic reviews and strategic initiatives, which is a slightly different term. I was talking to one of the fund managers in the sector and asked him about his strategic review. And he immediately corrected me quite sharply, actually, and said, that's not what it is. We're looking at strategic initiatives. So that's a slightly watered down version, because with strategic initiatives, and the wording is, subtly important here, what they're saying is that they're not saying they're thinking about winding up or changing manager or really changing the trust in a radical fashion. They're looking for more marginal improvements, maybe in the fee structure, or they might be considering whether they could merge with another trust as the continuing party. Anyway, there's a bit more of that going on, which I'll talk about, and also much better news, I think, from the battery storage sector, which has been the most beleaguered of all of these sectors. It's been awful. And I think we're seeing really much better news coming out of that sector now. So those things combined, I think, are really important. And I do sense that this is the foothills, really, of the recovery, and that we could be in the early stages of something. I'm expecting much more news. So if we have a look at a share price chart here, which is Aquila Energy Efficiency is the one that's really shot up, but another 4 trusts on this chart as well that have also had a decent month. And I think, you can see a bit of a turn here. This is a 6-month chart, and you can see for the first 5 months of it, they're basically all heading south. And then there is actually a fairly broad recovery over this last month. And I'm slightly nervous here about just getting excited about hearing the first cuckoo of spring and finding there's no follow through. But I think there will be. So maybe I can just talk about what's happened. And we'll start with the asset sales at Aquila Energy Efficiency. Now, this is a trust that's already in managed runoff, and it has been for quite some time, actually. I mean, it decided in June 23 to do this, so it's been getting on for 2 years now. And I think probably there's been a bit of impatience in the market, and it's very welcome news. There's quite a lot of relief that they have finally sold some of their big assets here at a very good price. And I think the market was really very pessimistic, or maybe they were just ignoring this trust, because it was on a discount of 47.4% a month ago. And it's come in quite a lot now, but it's still 35% or so. And I think that indicates quite a lot of skepticism about the prices they were likely to obtain in the market. And that's not unreasonable. I can understand why people are pessimistic. If you're a known seller in quite a tough market, maybe you're not going to achieve very good prices for your asset sales. But actually, they have sold big assets in Germany and Italy, and they got a decent price. I mean, 31.8 million euros against the book value of 33.9. So that's a relatively small discount. And I think that's very helpful, actually, not just for this trust, but for the sector overall, because I think it does show that if you have decent quality assets, actually you can sell them at good prices. And I think this is very relevant for Harmony Energy Income Trust, one of the battery storage trusts, which is expecting to sell its entire portfolio, although there's no guarantee it's going to do that successfully. And we've been waiting for that news to come through. The period of for the preferred bidder is coming to an end now on 10th of March. So I do think we'll get some news on that shortly. And it's quite interesting there that the shares are trading still on a 30% discount, even though potentially they could get a decent price fairly close to the asset value if they sell it well. So that's one to watch. I'm certainly going to be keeping an eye on that one. So that's the asset sales. The next thing is the strategic initiatives. And we've seen quite a lot of these coming out. And I do think it's really interesting. Again, from a talk I was having with a manager, I think one particular phrase he uttered was really relevant. And he said that the board effectively had felt in the early stages of this market derating that it was a cyclical derating, fairly normal, I mean, a bit sharper than usual, but they felt they could probably leave the market to correct it. And now they've realized that the market is not going to correct it, so they have to correct it. And I think that's a really important shift in the mindset here. And I think we're seeing that across quite a number of boards now in the alternative sector, and they're now not prepared to accept the status quo, so they're all acting. So you can see here there's 3 that over the last month have all issued statements. VH Global Energy Infrastructure, engaging with shareholders, considering potential options. Don't know what those are. Bluefield Solar, that was strategic initiatives, not strategic review. And that's a strong trust. So I think that one will be able to sustain itself. But it might look for a merger. It might look for a reduction in the fees. There are certain things it can do there to improve its performance and I think its rating. And then Foresight Solar Fund, that's considering a range of strategic options. So that might mean asset sales, it might mean a merger, it might mean nothing much. But the good news is that I think we're now entering this fresh period of activity by these boards. So I think that's encouraging. So the last point here now, battery storage. Every recent update has been really good, actually, and we have heard from all three of these battery storage trusts. They've all said that actually trading in the key GB market was much better in December and January. In fact, they had some record months there. And this is after a depressed period where they weren't getting great revenues from this sector. So that's really welcome news. Again, it's quite short term, so we'll have to see if we get the follow through. But I think there's more news as well, in that these trusts have been developing. They're making very good progress with the energization of their portfolios, which means they're shifting from the development asset phase to the revenue producing phase. And that typically means you get an uplift in value at that point. So this is all very welcome. And I think there's a lot of scope here for positive surprises. And the valuations are undoubtedly very depressed. You know, the Gresham House and Gore Street Trust are both on discounts of more than 50%, which is very wide. So let's have a very quick look at the US market weakness there. Two charts here. In both cases, the US is in red. On the left-hand chart there, it's plotted against the Euro stocks over the last 6 months. You can see there's a real inflection point at the start of the year where suddenly you wanted to have Europe and you wanted to shift out of the US. The other chart, also 6 months, is plotting the US in red against the FTSE All World Index in blue. And you can see there's quite sharp sell-off actually in the US market. And obviously a lot of that is down to the geopolitical background. It's what President Trump's been saying about tariffs and so on. And I think as well, that news from DeepSeek was really important because we know that last year's rally was so much driven by the big tech companies that when a little cloud was cast over those, it did hurt the market. So just one more slide that just encapsulates a few of these points here. I think there was interesting talk actually at yesterday's AIC Directors Conference about the economics of President Trump. And I think we are going to see a near-term hit from all of this tariff news, although there's just been a pause, hasn't there, in the Mexico and Canada tariffs. So we'll have to wait and see. I think the real point is here, there's a great deal of uncertainty now entering the market. And my sense is that many investors who had good exposure to the US last year will find that they've accidentally got quite a lot more US in their portfolio than they ever intended, because of course it outperforms so much that maybe now if you've got large holdings in very successful trusts like Polar Capital Technology or Allianz Technology, maybe a little bit of top slicing actually makes quite good common sense here. And I think that's particularly true as we are entering this new period in the tech sector now that China is undergoing something of a renaissance. And I think just on the very last point there, that's why India has sold off as well, because people are reassessing their exposure to these very highly valued markets. And against this rather risky looking geopolitical background, I think there's a good reason, I think, for selling out of some of those things now.
Great, thank you, Andrew. That was interesting and useful, I think. Actually, I was writing some down. We were talking. One might feature in my article this week. We'll see how we go. So we've got to move on now and talk to Phil. So thank you very much for doing this again, Phil. We're pleased to have you on. As usual, we're going to let you drive for a bit and tell us about the trust, and then we'll get to some questions. So if you've got any questions, please do put them into the chat box on YouTube. Over to you, Phil.
Great. Thanks, James, and thanks for the opportunity as ever to speak. By way of introduction to those I haven't met before, my name is Philip Kent. I'm the Chief Executive at Gravis and have been the lead fund manager on GCP Infrastructure for the last 7 years or so. In terms of today, I'm going to give a brief overview of the fund, capture, I think, what I think is the current market opportunity, given some of the market dynamics that you've heard in the call so far, and then touch a little bit on where I see the UK infrastructure market landscape and current opportunities. So to dive into the fund, first of all, so GCP Infrastructure focuses on UK-based infrastructure, where that infrastructure has some form of public sector-backed cash flows, with a focus in investing on debt, so picking up the top line of this slide. In terms of some of the history, we IPO'd back in 2010, so this year marks our 15th anniversary from IPO. We've been a FTSE 250 constituent for the last 10 years or so. Market cap of the fund is just over 600 million, net asset value of 911 million, and total investment value of around 950 million. The difference between NAV and investment value really is debt, so we're not a highly geared structure. At 31st of December, we had net debt, I think, of just under 20 million or so. Perhaps skipping to the next slide if we could. We run through on this slide the core objectives of the strategy, and these objectives have remained entirely consistent with those that we set out at IPO. Firstly, income. I think for most of this strategy's life, income has been the key reason why investors have found infrastructure as an asset class attractive. The fund's paid a stable, sustainable dividend now for the last 14 years. I'll come on to describe why I think that the portfolio is better placed now to continue to sustain and maintain that dividend than it has been over the life of the fund. And a core part of that goes to the second objective, which is diversification. The fund's had the explicit objective of targeting a diversified range of asset classes since day one. What that's meant has actually been really important for the strategy, given the change that we've seen in certain infrastructure asset classes over the last 15 years or so. We've seen asset classes like solar, PFI, PPP, wind significantly mature over that time frame, going back to the early discussions we had on solar with our investors. I think there were concerns on how those assets would connect to the grid, how they'd be managed in the context of the UK market, how the accreditations would work, what the risk was for a new asset class, the fact that investors didn't believe there was enough sun in the UK, all of which as risks have largely reduced over time just through the deployment of that asset class at scale. But also we've seen competition coming into the asset classes, and that combination of competition plus a better understanding of risks meant that discount rates, returns available in those asset classes has come down over time. The fund's reaction to that hasn't been to live or die by the evolution of those asset classes. It's been to move into other sectors that we find interesting, where we can capture, in our view, enhanced risk-adjusted returns by virtue of the fact we're coming into those sectors early when they don't suffer from competition and evolution of risk. The third objective on the slide, capital preservation, is absolutely key for us. There's two aspects to this. I think infrastructure by its nature is a defensive asset class. It benefits from the intrinsic value of physical assets that are performing a role for society over the long term. But also the fact that we focus on debt rather than equity investments within infrastructure means we're very focused in an investment process on how we get paid back. And all of the debt in our portfolio fully amortizes over the life of our investment, so there's no underlying exposure to residual value risk or bullet repayments at the end of an asset's life based on some perpetual value or long-term growth assumption. The KPI that we quote on this slide, so the 0.41%, what that is if we take the aggregate impairments or realized losses that the fund has occurred over its 15-year life divided by the total amount we've invested on an annualized basis, we get to 0.41% as an equivalent loan loss ratio or loss given default ratio. That reflects really well against any equivalent returning credit instrument. That number would typically be up in the 2% range for an equivalent yielding credit instrument. So for me, that demonstrates the quality of the underwriting process and the historic asset selection that's been the case for this strategy. The final box on this slide is ESG. ESG hasn't been a core objective of the strategy. Certainly when we IPO'd, ESG wasn't as important to many investors as it is today. But actually where we've ended up from an ESG perspective is a really positive place. We have just under £1 billion of assets, all of which have some form of key environmental or social purpose. And we've done a lot of work over the last 2 to 3 years to try and draw that out in quantitative terms in the interim and annual reports. And I'd encourage investors to look at that in terms of the positive impacts of the strategy. Moving to the next slide, and we present here a snapshot of the portfolio in the pie charts. Go into the inner pie chart first of all, the broad mix of the portfolio that we identify. Renewables make up just over 60% of the portfolio. And to my diversification point, you can see in the outer pie chart there how that's made up across multiple asset classes: solar, both commercial solar and rooftop solar, wind, biomass, anaerobic digestion, hydro, and some smaller exposures to other asset classes. Just over a quarter of the fund is invested in PFI PPP projects, predominantly in the healthcare, education, waste, and leisure sectors. And then 12% of the strategy today is invested in supported social housing. And we've publicly set out as part of our capital allocation program that we'll be reducing our exposure to that sector over time. To work through the boxes on the right-hand side that give a few more KPIs on the portfolio valuation 955 million across 50 investments. That's made up of a significantly higher number of underlying assets that sit within those investments, are well diversified from an asset perspective. The investments have a weighted average life of 11 years. A key metric for me is the fact that just less than 1% of the fund is exposed to a construction risk. That's a fairly material reduction in construction risk that's occurred over the last 5 or 6 years. If we go back in that time frame, that level was up at 16-17%. So we've been through the construction and commissioning phases in some asset classes that have presented themselves with challenges for us and others in those phases, biomass, anaerobic digestion as examples. But where we are now is that we have a mature, diverse and operational portfolio that operates well, including in respect of those asset classes where we've had historic challenges. And then the final one to pick up here is the bottom box, where we set out that just under half of the investments in the portfolio have some form of inflation protection, and that provides a natural hedge against the income generated by the portfolio in a higher rate environment. And we've certainly seen the benefits of that accrue to net asset value over the last 2 to 3 years. The following slide has a slightly different take on the portfolio. We break down the portfolio by income type, so the same inner pie chart there, but around the outside we set out where the revenues of the underlying projects are coming from. And as you can see, the vast majority of the revenues in the portfolio are underpinned by long-dated, inflation-linked public sector-backed contracts, whether that's a unitary charge under a PFI or PPP contract. That's the core payment mechanism under contracts with central government or local authorities, and then the various renewable subsidies such as the renewable obligation regime, the feed-in tariff and the renewable heat obligation. And then in the supported social housing sector, the government-backed revenue there is really underpinned by lease income that's backed off with housing benefit. The portfolio as a whole is generating just under 8% as a yield. What is available in the current market today in terms of what the underlying portfolio can be accessed by investors is a dividend yield of just under 10%. I'll come on to talk more why I think that's an attractive entry point. And that's a dividend that we've paid consistently and stably now for the last 14 years. The next slide tries to draw out an example of the portfolio. This is an investment that we made back in 2017, and it's a senior debt facility that's secured against the UBB Waste Gloucestershire waste to energy project. That takes the vast majority of Gloucestershire's black bag waste, and it burns that to produce electricity that's exported and would provide around 25,000 UK homes with renewable power. Takes in around 190,000 tonnes of waste every year, generates around 15 megawatts of capacity. That's equivalent to the 25,000 homes that I mentioned, and that's been procured as part of a 25-year concession with Gloucestershire County Council. And I think this is an excellent example of where Gloucestershire had a challenge in respect of their waste and where it was ending up in terms of going to landfill, and then as with any PFI PPP scheme, worked with the public sector to procure a financing model where the equity in this, and the original equity was a combination of Urbasa and Balfour Beatty, developed, were awarded and then built and operated, now operate this project. The senior loan, we have about 40 million outstanding. The loan's valued in our books at par. The overall interest rate on the facility is just under 8%. And as I set out earlier, that loan fully amortizes out to maturity in 2042. We did an investor site visit at this asset a year or so ago. I would encourage any investor who would like to be involved in those visits. I think it's an excellent opportunity to go around an asset and see it working in reality. And I think it also gives investors a real insight into the risks ultimately to which they're exposed. These are complicated operational assets, and there's a big diversity of operational risk in our portfolio, from solar and wind, which is relatively simple operationally, compared with assets such as this, which are very multifaceted in terms of processes and operational involvement. Perhaps move into the next slide, if we may, James. I think what we set out on this slide is a little bit of market position, and you heard from Andrew, I think, some really good commentary, I thought, on the listed renewables space. And this fund is often put in the peer group of the wider infrastructure equity managers, the renewables peer group as well, given the mix of the portfolio that I just set out. I think the first distinction I wanted to make on this slide is a difference between us as principally a debt strategy versus the other equity strategies are out there. We're very aware of the other listed debt fund in Sequoia. We really like those guys, and they've done a good job for investors, but they do focus on something that's slightly different from us, more focused on economic infrastructure. That's perhaps more GDP linked in terms of its performance. It has more perhaps demand risk in the revenues. It's a more geographically diverse fund, and perhaps has participated in more debt that's been originated elsewhere, rather than everything in our portfolio is bespoke and bilateral. GCP's focus has historically been on more environmental social infrastructure. That's more availability based in terms of the revenues generated by the underlying projects. So what that means is the projects are paid for being available for use, not based on how much they're actually used, and that's typically a more resilient basis of revenues. Certainly the capital allocation program that we've set out puts us more into that debt space as we look to exit some of the equity positions that the fund has acquired over time. I think, without going through the rest of the peer group, perhaps a distinction I'd make there is between an infrastructure risk versus a more private equity style risk. And I think we see a bit of a spectrum across the sector in this respect. For me, an infrastructure risk, and very much how we think about lending against infrastructure, is looking at an asset that does a job over its life. And our job is really to due diligence that asset over its life and understand the cash flows and the risk to those cash flows over the asset life. We're not thinking about a management team or entry into new markets or growth opportunities, and that feels much more like a private equity set of considerations. And I think if we're looking at some of the wider peer group where we've gone into regulated utilities, for example, that is a corporate that's got a regulated, non-regulated business. It's got employees, it's got pension liabilities, it's got a business strategy that may change over time. Similarly, as you're looking at some of the funds going into more developer vehicles, that's backing a management team to go out and use their relationships to procure consents and the enabling factors for a project that then they might sell or they might indeed develop. And again, that feels more like a private equity style risk. And this isn't me sitting here saying one is better than the other. The listed infrastructure equity fund in the top right there is 3i Infrastructure. That's done a great job for investors and is explicitly a private equity strategy within the wider infrastructure peer group. So this isn't a comparison of good or bad. I think it's more to highlight the difference, which I think it's important for investors to appreciate. And the final point I'll make here is that GCP does occupy some white space in what is a relatively congested wider peer group. So I think if we're looking at longevity of the funds and the role each fund has to play on an ongoing basis, I do think that GCP has a core differentiator in terms of its offering versus that wider peer group. To the next slide, I wanted to summarize the opportunity as I currently see it. And these charts, I'm sure, will be familiar to many listeners. So on the left there, we set out the UK's central bank rate evolution and look how that's evolved from IPO. And on the right there, the 10-year gilt history, which, given the fund's duration is approximately similar to that, I think is a relevant risk-free comparator. I think interestingly on that right-hand chart is the fact that that gilt rate is approximately the same as where the fund was at IPO, or where the gilt rate was at IPO going back 15 years. At IPO, the fund traded at a modest premium and sustained that premium at 10 to 15% above NAV for the majority of its life, arguably at that time on a relatively untried, untested model in sectors that were newer, and a mix of construction and operational risk in a vehicle that was scaling. Fast forward to now, we have a scaled vehicle that's materially operational, has a 14-year track record of paying a stable dividend, yet we find ourselves at an unprecedented discount. So perhaps go into the next slide if we may, James. Just to summarize the history of the fund, so the black line there shows the dividend that's been paid over time. As you can see, it's remained stable, with one dividend reduction that we made back in May 2020, really in response to low interest rate environment that had proceeded for the last 5 or 6 years prior to that point. Last year, we repaid all of IPO investors' subscriptions through aggregate dividends that the funds paid out over its life. I think it was a really important milestone. And then the green line here shows the NAV and how that's moved. And it's moved about a bit, but I'd argue in some of the context of some of the macro events that has punctuated that period, Brexit, nationalisation concerns, COVID, mini budget, the geopolitical tensions that are continuing, the NAV hasn't moved about very much. And actually infrastructure, if we're evaluating this slide, has largely done what we set out it should do. It's uncorrelated, it's defensive as an asset class. Yet we find ourselves at this unprecedented discount, which is shown on this chart here. It's just over 30% where we sit today. That's in the context of a mature operational portfolio that's paid a stable dividend for the last 14 years. I think the benefits of inflation protection across the sector more broadly has probably been underestimated in terms of the response to the wider rate environment. We have no interest rate risk in the underlying portfolio where there is senior debt and we're sitting in a subordinated position. That debt is all fully hedged with swaps in place at the underlying asset level. So for me, this demonstrates why there's such an excellent entry point to this fund, and I'd extend that to many of the strategies that Andrew mentioned earlier that I think have suffered from the same dynamics. In my mind, this discount really is a function of two things. Firstly, the fact that there's been a re-rating, and in a higher interest rate environment for a relatively long duration fixed rate stock, there is a natural re-rating that would happen in those circumstances. But the second thing, and I think this has probably had an outturn impact, is just a massive reduction in liquidity in alternative sources of income. And we've seen money flow out of sectors like infrastructure, renewables, in favour of perhaps more traditional sources of fixed income, so money market funds, gilts, corporate bonds, as an example. The next slide talks to the wider opportunity I see at the moment, and I apologise in advance for what is a very busy slide, but that's kind of the point I'm trying to make here. This country has set out some really aggressive targets in respect of decarbonisation, and I focused on this slide on decarbonisation. I could probably have a similar slide for the response to population change in terms of a growing and ageing population, and the role infrastructure has to play there. I could probably have a similar slide in respect of digitalisation as a macro theme. But focusing on decarbonisation, this government has committed to achieve a low carbon grid by 2030. What that practically means is all of the electricity generated and used in this country will be from low carbon sources, including nuclear, and they've capped in that the component of gas generation. But that's a massive undertaking from where we sit today, and by the government's own estimates, as you can see there, will require 140 gigawatts of installed capacity within renewables. That's up from just over 60 or so gigawatts that we have installed today. So a massive increase in renewable deployed capacity. If we look to other sectors, heat, transport as examples, almost 40 million EVs will be required on the road to get to the 2050 target, which is the whole economy will be net zero by that point. That's up from just over 1 million electric vehicles today. I think the same story for heat pumps. There's 30 million heat pumps installed. We've managed to install around 225,000 heat pumps in this country over the last 5 years. So there is a step change needed. And frankly, my perspective on this is whether it's 2030 or 2035 that we hit these targets, I don't think is the material point. The direction of travel here is really positive from an investment perspective, and we're starting to see policy aligned to promote this. I think there's some really interesting mechanisms that have been introduced around the cluster model, so how we look at the carbon removal model, the hydrogen business model that the government is introducing. That's taken the contract for difference model that's been really successful, particularly in offshore wind in the UK, and applying that to different markets to try and promote investment in new capacity. So there's lots going on in the background, and actually where this is and should be, and during a period higher rate environments, a good opportunity for lenders to be investing into some of these new mechanisms, doing what this fund has arguably done really well over the last 14 years, which is getting into sectors early and taking opportunities in those sectors, capturing high rates whilst we're doing it, in the context of the new policy environment that's occurring. The final slide I wanted to touch on is just a bit of a wrap up. We think at the current discount, the fund represents a really attractive entry point. We've paid a sustained long-term income historically, and the fund and portfolio have never been better placed, I'd argue, to continue to do that. And we're seeing the macro environment hopefully align as well. So the prospect of rate cuts, albeit perhaps slower than we all had hoped, I think will address one of those factors at least that I attributed the rating to earlier. So on a relative basis, these funds will look more attractive, and we're seeing an alignment of government support to promote new investment. And the ongoing work on cost disclosure, let's not underestimate the impact that that has had as well. And I think it's really important looking ahead to the composite cost index discussions and consultation that's currently out, that we're making sure that investment companies are accurately and fairly reflected from the perspective of cost as part of that. I'll pause there and very happy to take any questions through the chat room or I think directly to James.
There I am. Very good. Thank you very much, Philip. And so there's loads of questions actually, but there's some sort of theme to some of them. So I think to come back to the structure a bit and the dividend, if we go back to this one. So the dividend was obviously cut in 2020, and as you said there, in response to the fact that the rates of interest available had come down. But obviously the rates of interest have gone back up again. Do you think there's a possibility of dividend growth from this sort of level?
I do, and I absolutely acknowledge that the response was the dividend cut was in response to a low rate environment. I think the challenge I have is what we've said to investors and what investors have said to us in the current environment is, let's not invest now, let's return capital to shareholders through buybacks, let's deleverage, both of which we've started and have committed to. Leverage has been materially reduced over the last 12 months by around £100 million. We've started a programme of buybacks as part of a commitment to return a minimum of 50 million to investors. So the challenge there is, unless we're investing into that higher rate environment, we're not going to reset the return generated by the portfolio that can therefore lead to a response through dividend. I think the core discussion we're starting to have with shareholders, and this is definitely more of a theme in the discussions we've had over the last 3 to 6 months or so, is, well, what happens next? Does the company, once you're through the 150 million of aggregate deleveraging and buying back, what happens then? And really that's going to be a function of where the discount has evolved to through that process. But I think there is increasingly a set of investors that are taking the view, well, buybacks haven't really worked, deleveraging hasn't really worked, selling assets at NAV hasn't really worked, so actually are you better off just investing to invest into the prevailing risk and return environment? and by doing that, ultimately you're resetting the portfolio into the current market, and that should drive a re-rating. So so if we do that, then I think, you know, absolutely there's the scope to look at dividend again. I would make the point, and I've often referred to, it's a £1 billion portfolio. It's a bit of a super tanker. We can't switch it from today overnight, so it will take time. And I think for me, capital recycling will continue to be a theme. So the proactive disposing of assets or recycling debt through promoting early repayments from underlying borrowers, such that we can reset that quicker. But it's not going to happen overnight.
On that point, if the social housing deal happens, is it one big sale and one big influx of cash?
I mean, yeah, so we're looking at a number of options there. We've said publicly that across GCP and Gabi, with the other fund that Gravis manages, that's currently in managed realization, that we're looking to exit supported social housing. Clearly, I think it is more attractive for certain types of investor to look at a larger transaction, and I think that's a unique selling point in terms of what we can offer. The portfolios in both cases are made up of exposure to a number of different registered providers. So I think it's really a balance between optimizing the makeup of those sales processes to investors to maximize value. But we're not, you know, I think it's going to be a lot more straightforward and actually better if we can commit to that in larger transactions rather than many smaller transactions.
That makes sense to me too. If you were investing a brand new portfolio today, would it be all renewables, do you think? Is that the way it's going?
Yeah, it's a good question, and I think, you know, the fund's portfolio makeup historically has really been a function of where the UK government are looking to support, and the reality is that there are support mechanisms available in renewables, principally the contract for difference model. The biomethane support scheme is another one, and looking ahead to the carbon business model and hydrogen business model I mentioned earlier, there's potential new CFD mechanisms there. I think there are some other areas. I think the OFTO regime is another interesting support mechanism, which is more of a RAB-based mechanism, that we Gravis have looked at quite closely over the last couple of years. I think there's similar mechanisms in the water sector, so direct procurement for customers. So that's a model where new larger infrastructure, there's a couple of aqueduct or reservoir examples in the pipeline, will be funded by a private sector finance procurement scheme similar to PFI PPP. We have also seen derivatives of PFI, the mutual investment model in Scotland and Wales, continue, and a lot of the developed world still has some form of PPP type mechanism to procure new infrastructure. And I do wonder whether, given the state of the government's finances and at the same time the amount of social infrastructure we need to build across prisons, education, healthcare, that there is a potential sensible return to some form of private sector procurement model. So today, to answer your question, James, I think yes, I think the opportunities are immediately in renewables, and probably I would say that's a wider definition than just renewable electricity generation. And I think probably the more attractive opportunities are outside the heavily congested sectors of solar and wind. But looking forward, and I don't think we have to look forward too far, there may well be opportunities perhaps within an even broader definition of renewables, but also in some other sectors as well.
You've got a tiny amount of construction exposure, and you say it's less than it used to be. Does that provide an NAV uplift as and when things finish construction?
I guess given its debt, we don't have that sort of natural value uplift as you move from construction into operations. So I think no is the short answer. You know, the loans are valued at par today, and I expect they will continue to be, unless Mazars, who for this fund is an independent valuation agent, they set the discount rates that we apply to discount the future cash flows to get back to a value. No, I think is a short answer to your question.
And then in terms of kind of how the portfolio matures, what's the sort of average life of the loans in the fund, and how fast is it running off?
So the portfolio has a weighted average life of 11 years. I think the third box on the slide you've got up. there is a chart in the annual report that I'd encourage anyone interested in this topic to look at, and we set out the expected cash flow profile over the remaining life of the fund. I think supported social housing is relatively long dated, so there's a kind of long dated tail to those cash flows that's principally made up of the supported social housing portfolio. If we exit that, that would bring that weighted average life in probably closer to 7 or 8 years. I think in terms of the PFI PPP, that's historically where we've been subordinated debt. It's a sitting junior to a senior lender that in a 20-year concession might have a 15-year term debt. We're approaching the period where that sort of final 5 years of fairly significant amortization happens in some cases, as we look to those assets ultimately being handed back. So so that forms probably a bulk of cash flows over the next 5 to 7 years. And then renewables is a pretty sort of smooth amortization profile between now and when those subsidy regimes start expiring in 2027, in some cases through to 2036, 2037 in others.
Have you ever felt the need to go overseas for investments?
We haven't in this fund. I think it's something that we have thought about and debated extensively with the board over many years. I think that we've never probably had the need to, on the basis that that diversification objective that I set out up front has really given us enough scope to invest within the UK. I think investors have appreciated the fact we've stuck to our original strategy in that respect. We haven't introduced FX risks into the portfolio, but also other market risks that I think we've seen realize elsewhere, in other particularly renewables markets, where I slightly struggle, if I'm honest, to follow kind of government policy and where it's moving for UK infrastructure across a range of sectors. So frankly, as Gravis, we'd need to invest in teams abroad who really understand those specific markets and geographies, rather than pretending we know that and understand it from our current base. So so it's not something that we've naturally done, but at the same time, I think it is part of our role as investment advisor to the board to monitor what's happening elsewhere, and if we think there are interesting opportunities, to at least be aware of them, and bring them to the board's attention and potentially look at them in more detail if and when. The fund does have a 25% out of scope allocation that technically could be used for those sorts of opportunities, but it never has been.
The scale on this chart makes the NAV look a bit more volatile than it really is. I mean, if you sort of cut off at 85, so it looks like it's going up. But what's been driving the NAV falls in the last couple of years, and do you think they're done?
So we do have a certain exposure to more equity-like investments in the portfolio. That's a combination of where we've stepped into assets as a lender and taken control of those assets, and in pretty much all cases, that's been part of a decision that has maintained value for the fund. So we shouldn't, an investor shouldn't read we've stepped in as a complete disaster and write-off. It's not been that at all. In terms of other assets, we explicitly chose to invest in a more equity-like risk and a very highly subordinated debt risk that had no sort of upside benefits, but practically was taking all of the equity risk anyway. So we have, as I think the wider sector has been affected by reductions in power prices. I think the review that's happened more broadly of energy yields, in particularly the wind space, has affected us as well. We went through a process probably 6 to 9 months ago of reviewing our energy yield assessment on those wind assets we have exposure to, and that contributed to a slight reduction in net asset value. So it's been really a story of power prices, asset performance that's been consistent more broadly. There's a little bit of inflation. As inflation has moved around a bit, that's contributed to NAVs, and OBR inflation forecasts have generally over that time frame come down, and that's flowed through to long-term cash flow, nominal cash flow forecasts that are being discounted, particularly more in those equity-like investments. It has been a core focus of our capital reallocation program that we've set out to try and reduce exposure to those sectors. So I think I would acknowledge that NAV volatility has been, as you say, I think exaggerated by this chart, but I think investors would like it reduced even from that the level it's been at. So reducing equity exposures would certainly benefit that. But yeah, I don't think there's anything portfolio specific, and the drivers have really been consistent with what we've seen elsewhere.
You're probably not going to be able to answer this, but there are a couple of questions about other funds in the sector basing fees on lower market cap and NAV and or hybrid versions of that. Is that something that you'd be open to?
I think fees are, I guess, a consistent discussion between us and the board. Ultimately, recognise my conflicted position in this question. I think the argument I've made, and this is an argument I have seen others making elsewhere, is that we still have 50 investments, we still have the same job to do, and for our business, if we went to market cap, a 30% hit to our top line revenue is a material change. And I think Gravis, again, I acknowledge my conflict in making these statements, but Gravis has always provided an excellent service to both the board, who ultimately we report to, but also shareholders. And I think if there are any aspects of what we do that we can improve or do better, then I'm very happy, and I think have a track record of engaging with both shareholders and the board to do that. So if there is anything like that, please do reach out, and we're always open to hearing about it. But I think fundamentally our job is to look after a portfolio of assets. The work involved in that isn't linked to how the market values those assets. It's linked to the thing we can control, which is the value of those assets. So, and I would emphasise that the valuation is done independently of Gravis. It's set by Mazars as an independent valuation agent. So this hasn't actually been a massive topic of discussion in the discussions we've had with our shareholder base over the last 12 months or so. But I absolutely acknowledge it's a debate in the wider space.
Yeah, fair enough. And another one that, again, is maybe more for the board, but actually there was some attempts to merge this trust with others that didn't work out. And there's a question here about maybe the rump of Gabi could be rolled into this. I mean, is that something that you'd be open to?
I think we're reviewing all options for Gabi, and ultimately we're incentivized and absolutely want to secure the best result for Gabi investors as well as GCP investors. And I think the merger discussions had a clear thesis to it. Not all shareholders bought into that, which is why it didn't happen on both sides. But it's one we'll continually review, and we're getting through the realization plan on Gabi quite quickly, and I think we've returned just under 50% of that fund's capital at NAV within 6 months of the vote passing. So far so good. We realize there's another 50% to go, and there's lots of different options for that 50%, one of which is absolutely looking at this strategy. I would say that, again, recognizing the conflicted position there, that would be a discussion for the board, and ultimately they'd require their own independent advice on valuation, and would have a job to evidence that independent valuation. So it has to be in the best interest of both shareholders.
Brilliant, thank you. I think we should probably wrap up there. I will just finish with the usual question we do, which is to what extent are you and the team invested in the fund?
Yeah, so we are invested in the fund, and I think we set out the exact number, which changes every 6 months in the interim and annual report. But across Gravis, there's a fairly material holding from individuals in the fund. Certainly, from my perspective, it's an outsized holding, and outsized by quite a long way relative to sensible portfolio diversification. But that's the way it should be.
Good, thank you very much indeed. Sorry we had to wait for a bit to come on, but all very interesting and useful, and hopefully people find that useful. And do give us more questions if you have them. So we will be back next week, and our guest is a new face for AVI Japan Opportunity Trust, Nicola Takada-Wood. So we'll be talking to her. Have a good weekend and a nice week in the meantime, and I will see you next week.